Hey, good morning, everyone. Marty Mazzora. About an hour and a half after the open on Tuesday, March 15th, wanted to pop in just for a couple of minutes and just focus only on the daily S&P 500 chart, which is on your screen. Notice the S&P is at 3,001. So, folks, we're back above the 3,000 mark, and that's a good round number. So, I suspect that there are some folks just kind of on the edge of their seats right here. So the scenario would be, sell 3,000. We haven't been able to penetrate that. It's a round number, yada, yada. There's a lot of bad macro news out there. Um, should be some tough resistance. May very well be the case. We actually could see this thing come through here with some momentum. There's a lot of momentum in the market this morning and then fail. But also, the fact that what I just said is so obvious suggests that there may be, a good number of shorts just resting above that line. So think of it this way. So you have people who are, I'm looking for my drawing tool here. You have people who are really, buying into that narrative that, this market technically doesn't look so good, fundamentally under the surface doesn't look so good. Earnings, in the aggregate, probably not going to be good in the third quarter. That's certainly the consensus opinion. Although, the banks were mixed today. JP Morgan was good. Citigroup wasn't. Citigroup was okay. Goldman wasn't good. Johnson Johnson, real good earnings, real good revenues. So, mixed results so far, but on balance, not disappointing. You also got, or we're getting, some pretty positive rumblings on the Brexit situation. And if it's left to Northern Ireland right now, which is kind of the narrative this morning, we may be there. We may be, on the cusp of a Brexit agreement, and that is unequivocally bullish for the markets, no question about it. In terms of China, the big issue, China and the US, China is suggesting that what the president said about the 50 billion purchases of ag was premature and not settled. China says, they're going to have to really relieve or reduce or roll back some of their own tariffs on U.S. ag products to make that happen. But they don't want to do that unless the U.S. reciprocates. That's been tough for the president and the administration. They obviously are willing to not ratchet them up. This week we were supposed to ratchet some up, and they didn't do that. We have other ones on December 15th that are supposed to ratchet up, and I don't think the administration wants to. I think they want to let those go as well. Rolling back tariffs is really opposed to what the U.S. rhetoric has been. So may happen. Clearly, this administration has once again kind of changed tact or direction or the tone. Just a week and a half ago, it was going to be a 100% throw in the kitchen sink to the good of the U.S. or there would be no deal, to something dramatically different than that. Incremental, tiny deals, meaningless deal last week, quite frankly, in different phases and so on. So anyway, my point this morning is that if we rush through here with some momentum, there's going to be some shorts that are probably going to have to cover. Although I suspect there's really not a lot of faith, above this 3,030. That's the all-time high. We could get there. We could push through there. Remember, my base case has been consistently for weeks and weeks that we do get there, that in the short run, or better, 50-50, or maybe better than 50-50, that we do. That makes really a good sense to me because there's the potential, there's narratives out there that could make that happen. And right now there's enough, pessimism in the market, cash on the sidelines that could come rushing in and push this market up. And what do we have? We have another marginal new high. But folks, we have classic rolling over and momentum. And then ultimately, we have this look, which is your upward sloping wedge, right, against rolling over momentum. I could show you this back for decades. And this is probably the worst possible look you want on longer term charts. This is what it looks like before big corrections and before big bear markets. Doesn't mean that this can't push higher on a lot of good news and get us through this and resolve. And this all turn out to be one really big false signal. Think about in the context, longest expansion in history. I will never succumb to the notion that expansions die of old age. I will definitely say they die of excesses. They die of overstimulus. They die of stupidity, if you will, in terms of decision making. In this particular last run up in the market, it is really fueled by share buybacks. We've had manufactured earnings per share increases, financial engineering, if you will. Companies have spent more money buying back shares than they've had free cash flow to spend the last couple of years. So they borrowed to the hilt. Under the surface, we've got a corporate debt bomb that could blow up, or I think will blow up during the next recession. The question is, when is the next recession going to come? International Monetary Fund just downgraded its global growth forecast to the lowest in 10 years. I don't know that they've ever forecast recession, frankly, but it's slowing. The data that I'm showing you under the surface, our own index is slightly in the red. I showed you a whole slew of additional charts, and it's a file that just keeps on growing, titled Charts That Concern Me. So folks, as a money manager, as someone who looks at the market long term, who looks at the underlying trends, looks at prevailing bias, which is still higher, and then has to calculate what is the most likely scenario going forward. Where is the biggest move likely to be? The next big double-digit move in the market. What do probabilities say? Right now, frankly, probabilities are pointing to the next big move being lower. Could very well be that the next marginal move is higher, and it could pull in some people. It could be, if I'm right, it will be, the mother of all bull traps. People coming in, it's always that individual investor who comes in last. I listen to interviews with really good, macro managers. I listened to one the other day who said he got out of the market in May, doesn't like what he's seeing, and so on. Doesn't mean he's right, just means they're looking at the same stuff we're looking at. And they're saying that there are some global trends that are really concerning, that have gotten so far that even a trade war truce may not fix. On behalf of our clients, we have to be thoughtful, non-reactive, hedge when we have situations like we're seeing now, which is what we're doing. Going into next year, right now, here we are mid-October, and we are already beginning to model what we're going to be doing next year under different scenarios. If we have the same kind of probability setup that we have now and the market is here or higher, how do we protect portfolios and still squeeze some profits into them next year? If the market falls apart between now and then, that could change our whole narrative, could change the whole narrative globally in terms of how politicians are approaching the future and economies and so forth. But folks, there's a lot to digest. Right now, we're looking at the market, you can see fighting right here at 3,000, that's the S&P. You can see it's just kind of running into some headwinds right there. Volume is slightly below average. But it's okay. It's not it's not a low volume blah day. So there's definitely some action going on here. I imagine it's picking up right here at 3,000. We get through here with some momentum. You're going to see it spike higher as those shorts cover. You see it fail, and sellers are going to come in, and you drop below some of these other support levels, and it's going to start falling in a big way. So the jury's still out. Certainly the bias is higher. Could finally see that marginal new high that we've been talking about since back here. And I'll keep you posted on the developments. Right now, if we get that marginal new high relatively soon, it's going to do nothing but confirm this bearish look down here in the momentum, because we're going to end up with yet another low as we meet resistance up in here, which we no doubt will. So to feel technically better on the long-term charts, we're going to have to see these things resolve higher and see an upward slope here. We're a long ways from that. To see better things fundamentally, we're going to have to see just better looking data under the surface to have us feeling comfortable that we could break through this, see some inflation, have a good 2 or 3 years left, which was our narrative about a year ago, which clearly is no longer our narrative, and that's just based on the probabilities that we see. Leave it there. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.